Reader says to AK. Good to read about your property developer's portfolio allocation. I do remember your post about Gickeland from a few years ago. Singapore 1 developers are lowly valued and generally perceived as slow movers. Hobie has a big promoter holding, and I would not be surprised if there is a privatization offer. Sadly, such offers are usually low-ball offers, with the small retail investors having not much of a say. Their dividends are a decent consolation, but still not attractive from total shareholder return point of view. I have traded CDL and UOL on 3 occasions in the past few years. Each time, I bought when there was poor sentiment after property cooling measures were announced. I would hold for less than a year before exiting my investments, making out a 2% to 3% dividend yield as a bonus, with around 10% to 15% total gains. Now, I have started nibbling very small portions, hoping to do the 4th round. CDL has better yield at 3% to 4% now, but UOL is also not too bad either. Hoping to sow the seeds in small installments in 2023, and reap the mini harvest next year when rates fall and share prices go higher. AK says to Reader. Thanks for a very thoughtful comment. I agree that Singapore property developers aren't really attractive as investments. My foray into Tuan Sing was an exception, but only because I liquidated my position after an impressive run-up in its stock price. The incentive to sell after that massive price appreciation was strong, as Tuan Sing was a terrible investment for income. So, it was definitely an asset play. In contrast, when Hock Lian Seng's share price doubled, I sold only half my investment because I rather liked Hock Lian Seng's dividends. The idea of getting free money for life was strongly appealing to me. In my retirement, passive income is really my #1 consideration. Of course, I am also too lazy to trade stocks actively these days. Back in 2017, I said the following. One of the things that I like to do is to buy into what looks like a fundamentally sound business when insiders are accumulating. One such stock which has amply rewarded me over the years is Hock Lian Seng. I already had a small position in Hock Lian Seng, but decided to buy more in 2011 when I observed insiders buying. Back then, I paid 24 cents a share. Fully confident that the company would be able to continue with a dividend per share or DPS of 1.5 cents, I was looking at a dividend yield of 6.25% back then. That was in October 2011. A few months later, in February 2012, Hock Lian Seng declared a DPS of 2 cents, which translated to a dividend yield of 8.33%. That it represented only 32.8% of earnings was pleasing. They were retaining earnings, which increased the value of the stock. In both 2013 and 2014, Hock Lian Seng declared a DPS of 1.8 cents. In between, I had an opportunity to add to my investment, paying 26 cents a share in May 2013, confident that a DPS of 1.5 cents remained undemanding. Anything more would have been a bonus. I was not disappointed. In 2015, Hock Lian Seng declared a DPS of 4 cents. Mr. Market's exuberance went through the roof. At the time, I cautioned that the 4C DPS was a one-off event and unlikely to be recurring, as Hock Lian Seng saw its share price rocketing. Too many analysts and investors were waving the 4C DPS around as if it was a regular event. I won't be surprised if there were many newly minted Hock Lian Seng investors that year. I did not add to my investment, but, throughout the buzz, I held on to my investment and enjoyed a dividend yield of 15.38% to 16.66% that year. Hock Lian Seng's sound fundamentals caught the attention of Mr. Market and its share price went ballistic. I understood that selling about half of my investment in Hock Lian Seng would make my remaining investment free of cost. I talked to myself, I listened, and I acted accordingly. Since my remaining stake in Hock Lian Seng is free of cost, what should my dividend yield on cost be? My blog is not very cerebral in nature because I am not a very intelligent person.